Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Business and Commercial Knowledge. In this lecture, we'll continue with Chapter 1, that is Business and Commercial Knowledge and Introduction. All the concepts will be covered in the coming series of lectures. This is lecture number 4. Let us begin. In today's class, we'll begin with the forms of business organization. We'll begin with the forms of business organization. While elaborating business as an economic activity, we have seen that the forms of business may be discussed on a variety of criteria. For example, on the basis of nature of activity undertaken, and a business may be engaged in an industry, trade, or commerce. Industry, trade, or other services. And on the basis of size and scale of activity, business may be classified into micro, small, medium, and large enterprises. For the protection of micro, small, and medium enterprises, there is an act also, that is micro, small, medium enterprises development act 2006. Generally, however, whenever we refer to the forms of business organization, the attention is drawn to the types of private business ownership. Before we take up a brief discussion on the various forms of business ownership, it is important to take note of the following points about business ownership. The first point about business ownership is a bundle of rights. Ownership is a bundle of rights. These rights accrue because a person has invested money in it, money in the business. First, such right is a titular exclusiveness. If you own a book, no one else can claim the ownership of that book because you own the book. Others may own their respective copies. You may use it, that is, derive benefit from it. You may also lend it or sell it or donate it on your will. Likewise, business ownership occurs by investment of capital. Profits states belong to the owners. However, if there are losses, these have also incurred by the owners. Business owners have a right to run the business, operate the business, that is, manage and operate the business on day-to-day basis. However, a certain forms of business ownership can be separated from the management. Over here, this is an example of company form of business, joint stock company form of business. An important right associated with the business ownership is the right to dispose of and transfer the ownership of the business. It also includes transfer of ownership by succession after the owner's death. Such a succession occurs smoothly when the person acts prudently and divides the ownership in business among the successors by the registered will. I believe you understood. Second, business may be owned singly or jointly. There could be a single owner of the business And it may happen there could be many owners of the same business. They jointly own a particular share, a stake in the business. A business may be owned singly, that is, as a sole proprietorship, sole tradership concern. Else, it could be organized as a partnership or even a large collective, such as a cooperative. When owned singly, if all the profits belong to single owner, so too, so do the losses. Shared ownership by pooling of capital will facilitate undertaking the large projects. However, there is a prudential reason for shared ownership too, and that is sharing of risk. So, if the business operate in a company form of business, in that case, the ownership is shared between the shareholders and the risk of the business may be shared. This also happens in a partnership concern. Supposingly, in a partnership, there are five partners with equal share of 20%. That means what? That the share of profit, that is 20%, is shared, but the share of losses also, that is 20%, the risk is also shared between the partners. I believe you understood. Joint family business or Hindu undivided family business. Joint Hindu family business or Hindu undivided family business. A concept equalizer, a concept equalizer to Hindu undivided families in India views businesses as a family property and vests its ownership among the members of the family. Here, the sharing of ownership is guided not as much by the possibility of raising large sums of capital or diffusion of business risk as it is guided by the consideration of equitable distribution of ownership rights among the family members, like between the co-partners. In fact, business organization theorists and thinkers keep contemplating on forms of ownership whereby the impact of business advertise on ownership, business adversities on ownership, whether single or joint, can be minimized. One such innovation is the idea of limited liability. Since business persons own the business with all its liabilities and assets, all such, all its infrastructure, all its usufructs, whether favorable, that is profits, or unfavorable, that is losses, accrue to them. And in the event business liabilities are more than business assets, their personal wealth could be utilized for meeting in the business liabilities. There is no distinction between the business person and the business. In case of sole proprietorship, there is no distinction between the business person and the business. The idea of limited liability caps the liability of the business person just to the extent of the investment in the business. The idea was initially implemented in company form of business and later on the partnership as well, that is limited liability partnership, LLP. LLP. Business may be organized as a proprietary or a corporate concern, as a proprietary concern or as a corporate concern. In proprietary concern, business owners actively participate in day-to-day working of the enterprise, known as owner managers, known as owner managers or business persons or entrepreneurs, are thus not passive providers of investment capital alone. Business thus automatically becomes insubservient to the self interest of the owners. Obviously, such a situation would be more feasible when there are 4 to 5 co-owners and the nature and size of the business is such that it can draw on their competencies and capabilities. Let us think of businesses where number of persons holding a share in the capital of the enterprise is large, that is in hundreds, thousands, and hundreds of management would be inevitable, and hundreds of thousands who are also geographically dispersed. In such a case, a separation of ownership of management would be inevitable. The manager acts as an agent of and in the interest of the owners, share owners, the principals. Further, organizations of business as a corporate entity endorse it with a certain other peculiar characteristics too that we will take up as we describe the company form of business. We have already seen that such a form is characterized by limited liability of the own share ownership. But in a company form of business, what exactly happens is ownership is different. Ownership is with the shareholders. The management is with the board of directors. There is a board in the company which manages the whole company, who takes the decisions in relation to the company. Shareholders do not have decision making power. The board of directors have decision making power in a company. As far as the liability is concerned, the shareholders have limited liability. The shareholders have limited liability to the amount invested in the business. We have already seen that such a form of characterized by limited liability by the share owners. A serious limitation of proprietary business is that the life of a business is entwined with the health and life of the owners. If the owner is not well, on the death of the owner, the business come to an end in case of sole proprietorship. But in case of company, the health of the owner, that is a human, that is a person, would not affect the health of the company, the financial soundness or financial health of the company. Corporate form does away with the limitation as a company exists as a separate person, distinct from its owners in the contemplation of law. As a separate legal person, it can thus have a life of its own independent of the lives of the owners. I believe you understood. Having familiarized ourselves as to the fact that a business ownership is a bundle of rights, right to manage the business, right to operate, right to take profits, right to take decision, sell the business, give it on rent. B. A business may be owned singly or jointly. In case of partnership, generally there are more than one owner. So minimum owners in a partnership concern is two. In case of sole tradership, singly. In case of sole tradership, single owner is there. In case of partnership, joint owner is there. C. And that a business may be organized as a proprietary or a corporate concern. Let us examine the various forms of private business more closely. The first form of private business is sole proprietorship. The first form is sole proprietorship. Sole proprietorship. The meaning of sole is single and proprietor is owner. This means sole ownership, single owner. Single ownership. When an individual makes a choice to start a business of owns one's name, one's own, to be own's boss, sole proprietorship emerges. He do not need to follow the instructions of others. He is the boss of his business. As such, it can be regarded as the easiest and earliest form of a business as a human occupation. One may open a daily needs store in a room of a corner of one's house, or may just set up a shop on the pavement in weekly bazaars, or may open up a machine shop in the backyard or in a thinly habituated lane of a not so distinct locality. This form of business ownership is much appreciated in entrepreneurship literature. The sole entrepreneur is regarded as an economic hero. He takes his own responsibility. He is an independent person, an autonomous individual who organizes the production, uses creativity, ingenuity in innovation, bears risk and uncertainty. Drawing analogy from music, the sole entrepreneur is not merely the composer and director of the enterprise orchestra, but also a one person band. Of course, when a person grows, such an autonomous behavior becomes a limiting factor, as the entrepreneur, that is, sole proprietor, is required to share decision making and let go control over the business. The business undertaken could be on such a small scale that it can be hardly distinguished from self employment. It may not be even registered as a micro or a small scale business, enterprise, or industry because registration is not required in case of sole tradership. It is an interesting fact that is a very high proportion of micro and small businesses in India are unregistered. Usually, these enterprises, more so local retailers and street vendors, are so well integrated with the communities that these enjoy people trust and provide personal services to their customers. Together, these comprise the unorganized or informal sectors of an economy. It is significant to note that even though individually these might appear of not much impact, yet collectively such enterprises make a tremendous contribution to the national economy. You have seen that numerically these enterprises are the largest. Their collective contribution to the GDP is huge. Employment and even exports is very impactful. The impact is even more considerable when we take into account their indirect contribution as a supplier to larger and even multinational enterprises. Their importance is summed up in the cliche small is beautiful. Small is beautiful. I believe you must have heard this phrase. So we can say that as a summary, these are the small entrepreneurs, the small sole traders who are present in the society in an organized manner. The street food vendors are the sole traders. The small shop owners are the sole traders or sole proprietors. So these are present in the society very tightly in a kind of tied up manner, and a lot of goodwill they generate in the society. People know them by their names. So personal touch is a very impactful thing in case of a sole tradership. Consumers or customers know the sole trader by their names. The way he dresses, his looks, his accent, the style he follows, the way he talks to the customer, the way he helps the customer and solves their problem. A lot of personal influence and personal touch is involved in case of sole tradership, which is not present in case of company form of business. Because generally in a company form of business, customer and the owner of the business, they don't see each other. On the flip side, on the flip side, products from such enterprises are often derogatory called local to distinguish from branded. Local to distinguish from branded. The Prime Minister of India has given a slogan vocal for local. Vocal for local. This means we have to protect what is local. We should buy the local products which is manufactured in India so that the GDP will be positively affected and the small traders which are a part of unorganized sector should be able to survive, and this will strengthen the India's economy in a very positive manner. In common perception, working conditions in these enterprises are poor. These enterprises are believed to follow hire and fire policy, lack of employee welfare measures, lack system of effectively deal with the social and environmental concerns. Fate of the enterprise is linked with the personal well-being of the owner. This adversely affects consistency of services of such enterprises as the supplier to large and multinational enterprises. It also affects adversely those desirous of long-term contracts with these enterprises. For these reasons, large and multinational enterprises prefers to transact business with corporate entities. I believe you understood. The foregoing paragraph briefly evaluate the role of small sole proprietary firms in the economy from the BCK perspective, and this is going to be our focus henceforth. It would be more useful to examine this and other forms of business organization from the point of view those created. In sole means single individual. Proprietorship, in sole proprietorship, the individual essentially relies on personal savings and assets, example, room of the house, home furniture, personal bicycle, vehicle, to compromise the initial capital of the business. Note, investment of cash or in kind by the owner is called capital. This means what? The owner of the business could invest funds in the business. He may start the business with cash. So supposingly there is a so investment, basically I want to explain you, investment could be in cash, investment could be in kind. A business could invest rupee 1 lakh in the business. This is cash, investment in cash. Kind, he supposingly he takes the furniture, his personal furniture, and invest in the business. So furniture, that is an asset, or the car, motor car, this will act as an investment in kind. I believe you understood this. You must have learned the journal entry for that which is not relevant over here, and generally we do assets, so cash account debited to capital account. Over here we'll pass the journal entry, cash account would be debited, furniture account would be debited, motor car account will be debited to capital account. Fine, but journal entry is not relevant over here. However, in the modern economy, where the financial system is fairly developed, it is often possible to obtain microfinance. Loans in small denominations, say a thousands or two, and bank finance. So microfinance is even smaller than bank finance. In even better developed a financial system where the importance of entrepreneurship and business is recognized, there may be business facilitators who may assist the individual in obtaining finance and other help. We shall be reading about it later. Okay, so good news is that in India there is a lot of emphasis on business, startups and entrepreneurship. As a result, sole proprietary firms sole proprietary firms are able to quickly attain a commercial scale distinguishable from self-employment. All the profits of the enterprise accrue to the sole proprietor, and so to do the risk of a business. Let's see the features of sole proprietorship in detail. The features of a sole proprietorship in detail. The first feature is sole proprietorship will give you a lot of autonomy of being one's own boss. Merit. It's a merit also. If you will be your own boss, it will act as a feature as well as it's a merit. Because of freedom from the restriction of paid employment, ample scope of experimentation and expression of one's creativity and innovativeness. You can use your creativity, you can use your brain. If you want, you can do innovations. You don't need to ask anyone. You can take your decisions. All the decisions will be taken by your own. Next, sole provider of capital. This means a sole trader invests capital solely. It's a limitation, because if you every person is having a limited capital. If that limited capital is invested in the business cannot grow beyond a level of capacity. The limits the size of the business. This limits the size of the business. Yes, banks and lender may provide additional resources, help, loan. However, borrowing capacity too is determined by the capital adequacy and the capital invested, the credibility of the person, the financial credibility and credit of the person in the society, what assets he already have. These features also limit the capacity to expand. Capacity to grow and expand. Third is visibility of the owner and personalized services. Merit. For example, the personal rapport with the customers endangers trust and loyalty. So generally, the sole trader makes a positive rapport with the customers, and that is why a level of bonding, trust and loyalty comes into picture. A friendship happens between the customer and the sole trader. The next is sole bearer of risk. Sole bearer of risk. Limitation. It's a limitation. This arises from being a sole provider of capital. If all the profits belong to her, so do the losses. It's obvious. He's a sole profit recipient, but he's a sole risk bearer. He's a loss recipient also. Unlimited liability. Unlimited liability. It's a limitation. So a sole trader is having an unlimited liability. The personal assets are also attached if he is not able to pay up the debts. It is a common limitation of proprietary form of business organizations. In the event of insolvency, that is, liabilities is greater than assets, the owner's personal property, the personal assets are invoked to make up the deficit. This is not in the case in case of a company form of business. I believe you understood this. I believe you understood this. Fate as a going concern equals enduring life of business in a foreseeable future. This will act as a limitation. Sole proprietary entities going concern status depends on the owner's personal health and lifespan, and after his death, upon the willingness and the ability of the higher successors in the family. Do it once more. Sole proprietary entities going concern status depends on the owner's personal health and lifespan, and after the death upon the willingness and the ability of the heirs and successors of the family. If after the death of the person, if the legal heirs or successors don't want to continue the business, they can do so. There is no problem. There is no legal bounding or obligation. Next is succession of ownership. Succession of ownership is by will, by testament, or application of law of inheritance. A will or a testament is a legal document by which a person, the testator, expresses their wishes as to how their property is to be distributed at death and names one or more persons, the executor, to manage the estate until its final distribution. If the will is non-existent, that is, for intestate succession, the applicable law of inheritance will come into force. For example, for the Hindus, Parsis, Buddhists, Jains, Sikhs, the Hindu Succession Act 1956 is applicable. The succession of ownership happens according to the Hindu Succession Act 1956. I believe you understood till here. I believe you understood the sole proprietorship in detail. We have done the meaning of sole proprietorship. We had also completed the features of sole proprietorship. We are now shifting to the new concept, that is Hindu undivided family business, that is HUF. HUF, Hindu undivided family, is an entity formed automatically by members of the common ancestry including their wives and daughters. A Hindu undivided family cannot be formed by a group of people who do not constitute a family. So, Hindu undivided family is only done by a family. Two friends can come together and start a HUF, it's not possible at all. As such, a Hindu undivided family in India, in fact, and by default, a HUF enjoys a separate entity status under the Income Tax Act 1961. The Income Tax Act considers HUF as a separate entity if the joint family wishes to register itself as such for reporting income under the following heads: profits, profits from business and profession, income from house property, capital gains, income from other sources. Since under the Income Tax Act, HUF is a separate entity from the joint family that comprise it, a HUF cannot earn income from salary. A HUF cannot earn income from salary. We are concerned here with the business owned by the HUF, or simply stating joint Hindu family business, that is JHF, or Hindu undivided family, that is HUF business. Before we describe its features, it would be appropriate to clarify a few points on its meaning. The meaning becomes clearer with reference to the prevalence of joint family system in India. Families is formed by marriage. Family is formed by marriage. Let's call it the first generation. Marriage in most societies is a means to create progenies, that is children. Thus, there is second generation comprising the siblings. These siblings grow up, get married and have children. Now there is a third generation, a consortium of cousins. In the paternal lineage, thus there is grandfather, father and grandchildren. these three successive generations, three successive grandfather, father and grandchildren of a undivided family are known as HUF. Grandfather, father and children's. These three generations constitute a Hindu undivided family HUF. Secondly, through the word Hindu is conspicuous. The definition of HUF includes Buddhist, Jain, Sikh families as well. Thirdly, for the purpose of understanding HUF features as a business entity, another important relevant law is a Hindu Succession Act 1956. Let us see the features of Hindu undivided family business in detail. Features. First, formed by birth in a Hindu, that is Buddhist, Jain and Sikh family, it will also act as a merit. So family members may naturally join each other in business. In contrast, in a Muslim family, if the siblings wish to associate in a business, they will have to do it contractually. Example, partnership firm. It is not possible as per HUF, Hindu Undivided Family, because the Hindu Succession Act 1956 do not applies and is not applicable to Muslim families. Second, family pool of resources, that is money. Family pool of resources, that is money. It is possible to start, expand a large business. Moreover, the common pool of capital may be utilized to diversify business in sync with the aspirations of the members of the successive generations of the family. So they pool resources together and start the HUF. Third, social capital through family involvement. There is an instant trust between the family members. There is an instant trust among the family members as compared with the situation of partnership with strangers. Family members toil hard to build the family business. Moreover, they may specialize in different business functions for greater complementary of the mutual skills. It may happen that the son is a graduate or must have done MBA in HR, so he can handle the human resource department of an HUF. Father can handle the production department. Grandfather can handle the marketing department. And accordingly, the business could do well. Hindu undivided family business could do well. Next, the family members are the automatic co-owners, also known as co-partners by birth. The family members will get the ownership by birth, will get the membership by birth, and they are known as co-partners. Co-partner means co-owners. Ownership in family business is an ascribed rather than earned status by birth. It is actually be quite frustrating for the outsiders. Example, hired managers who help build the business. Next, decision making is quick. Quick decision making. Merit. In the absence of other active major members of the family, the head of the family is known as Karta in HUF. The head of the family is known as Karta. Family is known as Karta in an HUF, and the other members is known as co-partners. Karta take all the decisions in a HUF business, family business, and the decisions are applicable to all. Subsequently, decisions are taken by in the family. Prevalence of mutual trust, informality of communication makes decision making quick. Decision making quick. Next, Karta, the liability of Karta is unlimited. So unlimited liability of Karta and other member, that is co-partners, they have limited liability. Karta is the head of the family. It is a common limitation of proprietary forms of business organizations. In the event of insolvency, that is, liability is greater than assets, the owners, here the Karta, personal assets are invoked to make up the deficit. To make up the deficit, however, the liability of the other family members is limited to the extent of their share in the co-parcenary. Next, fate as a going concern. Fate as a going concern. Going concern equals enduring life of the business in a foreseeable future. Limitation: few family businesses last beyond third generation. Often family feuds result in business splits. In India, the splits in the business houses of Birla, Modi, Goenkas, and more recently the split of the second generation of Ambanis are instances of this effect. Next, succession of ownership. By will, that is testaments, or applicable to law of inheritance. A will or testament is a legal document by which a person, the testator, expresses their wishes as to how the property is to be distributed at death. The names one or more persons, the executor, to manage the estate until its final distribution. If the will is non-existent, that is, the intestate succession, the applicable law of inheritance will come into force. For example, for Hindus, Parsis, Buddhist, Jain and Sikh, the Hindu Succession Act 1956 is applicable in case of Hindu undivided family. Succession of ownership, and as you already understood that three generations will constitute a Hindu undivided family business. The head of the family will act as a karta and others will act as a co-partner. Co-partners have limited liability and karta is having the unlimited liability. I believe you must have understood the concept of HUF well. You must have understood the concept of joint Hindu family business, which is also known as Hindu undivided family. HUF is not applicable to Muslim families, and Hindu Succession Act 1956 is also not applicable to Muslim families and their businesses. If Muslim family wants to start a business in family, they need to form a partnership. They need to form a partnership. Let's begin with partnership. Let's begin with partnership. Partnership implies contractual co-workership, co-ownership of business. Partnership employs contractual co-ownership of business. It is a relationship between two or more persons who agree to share the profits of the business. The business may be carried on by all or any one of them acting for all. So, by some of the partners called active partners for and on behalf of all. The contract on agreement enforceable by law is a deed. So deed or agreement, it's a partnership agreement or partnership deed is there between the partners, and that deed or agreement is the essence of partnership. That deed or agreement is the essence of partnership. It may be verbal or written. Deed could be verbal. Verbal deed or verbal agreement is okay, is fine. But written agreement is suggested, advised. It specifies it specifies the basis of associations of a person in a partnership business. Example: capital contribution, profit sharing, The deed may be registered in India under the Partnership Act 1932. The deed may be registered in India under the Partnership Agreement 1932. I believe you understood. So partnerships come into existence. The deed is the essence of any partnership. The deed could be an oral deed, verbal deed, or written deed, that is agreement. A oral agreement or oral deed is also fine, there is no problem, it's correct, will do, but a written agreement or written deed is always advised. So later on there could not be any issues or problems. Let us see the key features of partnership concern. The first feature is agreement. The agreement makes possible co-ownership by business, by persons who do not share a common ancestry of a family. I repeat, the agreement makes possible co-ownership of a business by persons who do not share a common ancestry of a family. That means the two persons are belong to a different families. They come together and start a business, and being the co-owner in that business, it is possible by agreement or deed in a partnership firm. Next, two or more persons. The minimum partners is 2 and maximum is 20. Maximum is 20 for other firms and maximum is 10 for banking firms. Let us see. So partnership allows raising the fund beyond the resources of an individual sole proprietor. In fact, even a company being an artificial person can be admitted as a partner. I repeat, even a company being an artificial person, because an artificial person is also a person. So being admitted as a partner in a partnership firm. Limitation. There is a cap on the maximum number of persons. It is 10 for banking firm and 20 for other firms. The reason for a cap on the maximum number of persons in partnership, or for that matter any other non-corporate association, is the difficulty in tracing the owners, their hires during such circumstances as insolvency of the firm. Let's remember, partnership enjoins unlimited liability on the partners. So, in a partnership firm, the partners have unlimited liability. They do not have limited liability. So, as such, the sole tradership is also having unlimited liability. In a partnership firm also, the partners have unlimited liability. In a HUF, the Karta is having unlimited liability and other co-partners will have a limited liability, but there would be only one Karta in an HUF, and that would be the head of the family. Next, profit sharing. Profit sharing. Profit sharing is on the basis of agreed ratio between the partners. Profit sharing is on the basis of agreed ratio between the partners. For there is a risk sharing too. However, while profit sharing is an essential feature of partnership, loss sharing is not. Certain partners may have admitted only in the profits of the firm. Example, minor partners. So if you are admitting, if you are taking a minor person as a partner, he will become the minor partner. Minor partner is the one who shares only profit and do not share losses. So minor partners is only the partner in profits and not in they will not bear the risk of the firm. So they will not share the losses in case of minor partner. But if someone is adult, in that case, that person will share profits and losses on the basis of profit sharing ratio. On the basis of profit sharing ratio, which is generally written in the partnership deed or partnership agreement. In case of no deed and no agreement, the profit sharing ratio will be equal. The profit sharing ratio will be equal irrespective of the capital invested. I repeat, irrespective of the capital invested, the profit sharing ratio will be equal. I believe you understood. I believe you understood this. The next is business object, quite wide. Business object, quite wide. Merit. A partnership cannot be formed for non-business purposes. However, the word business here includes every trade, occupation, and profession. For example, many accounting and auditing and legal firms are organized as partnership firms. So many accounting firm, auditing firm, the legal firm, law firms are organized as partnership firms. So a partnership cannot be formed for non-business purpose. However, the word business here includes every trade, occupation and profession. Okay, let us continue. We have seen the features of partnership. The next is mutual agency. Mutual agency. That is, one of each and other and for all ensures that all the partners work in a common interest. All the partners work in a common interest and in an interest of the firm. Limitations. A partner misdeeds impact all the partners and fate of the firm. For example, if a partner in an auditing firm becomes a party to the corporate scam, its impact may be disastrous for the firm. So mutual agency means what? All the partners will work. Mutual agency means what? All the partner will work in interest, in common interest of the firm. That is for raising the profitability of the firm, to work in the interest of the firm, in favor of the firm. I believe you understood. And no partner should be a part of any scam. If they do so, the impact would be very disastrous. The next is unlimited liability. Unlimited liability. It is a common limitation of proprietary forms of business organization in the event of insolvency and liability is greater than asset. And as I told you that in partnership firm the partners have unlimited liability, the personal assets will be attached in the business for the payment of that liability. So the partners personal assets are invoked to make up the deficit, to pay up the liabilities. Owing to the mutual agency, the liability of all the partners is both joint and several. Is both joint and several. Next, fate as a going concern. Going concern equals enduring life of business in a foreseeable future is uncertain. Is uncertain. Since partnership arises out of contract, it also ceases in a same way. A partner may serve as a notice of severance of the firm and partnership comes to an end. The remaining partners may agree to carry the business of the firm. However, the severance cost and the loss of the momentum makes partnership a vulnerable form of business organization. Next, succession of ownership. Succession of ownership. Limitation. Ownership is not easily transferable. A few partner can be admitted only if other partners' consent is taken. So a new partner can be admitted only if all the other partners will give the consent for the admission of a new partner. I believe you understood. The next is right types of partners. Types of partners. Active partner. The first type is active partner. An active partner an active partner is one who who contributes capital, participates participates in the management participates in the management participates in the management of the firm, shares shares its profits shares its profits and losses shares its profits and losses and is and is liable liable to an unlimited to an unlimited extent to the creditors to the creditors of the firm creditors of the firm. Those partners those partners take actual part takes actual part in in carrying out business of the firm carrying out business of the firm on behalf of on behalf of other partners on behalf of other partners. So this was about active partners who take in the decision making process on behalf of the other partners. Next is sleeping partner. Sleeping partner or or dormant partner. Sleeping partner or dormant partners. Partners who do not take part partners who do not take part in the day to day in the day to day activities in the day to day activities of the business day to day activities of the business are called sleeping partners are called sleeping partners sleeping partners. A, a sleeping partner, a sleeping partner, however, a sleeping partner, contributes, however, contributes capital, capital to the firm. A sleeping partners, however, contributes capital to the firm, shares its profits, and losses, and has unlimited liability, and has unlimited liability, and has unlimited liability. Just the thing that a sleeping partner do not participate in the decision making process. A sleeping partner do not take active participation in the management of the company. in the management of the partnership firm. In the management of the partnership firm. Secret partner. Secret. Secret partner. A secret partner. A secret partner is one. A secret partner is one whose association whose association with the firm association with the firm is unknown is unknown to the general public to the general public other than other than this distinct this distinct feature in all in all the other aspects the other aspects he is he is like the rest of the partners. He is like the rest of the partners. His association is not known to the general public that he is a partner in that firm. He contributes he contributes to the capital. He contributes to the capital of the firm. He contributes to the capital of the firm, takes part takes part in the management, takes part in the management, shares shares its profits, shares its profits and losses, shares its profits and losses, and has unlimited liability and has unlimited liability liability towards the creditors towards the creditors. I believe you understood this. Next is nominal partner. Next is nominal partner. A nominal partner a nominal partner is one who allows a nominal partner is one who allows the use of who allows the use of his or her name by a firm by a firm but does not contribute but does not contribute to its capital does not contribute to capital. He or she does not take does not take active part does not take active part in managing in managing the firm, does not share its profits does not share its profits or losses does not share profits or losses but is liable like other partners but is liable like other partners. So the third parties, so the third parties for the repayment, so the third party for the repayment of the firm's debt, of the firm's debts. I believe you understood. So, a nominal partner is one who allows the use of his or her name by the firm but does not contribute to the capital. She do not take active part in the management of the company, does not share the profits and losses, but is liable to the firm's debt, which is there to the third parties. I believe you understood. I believe you understood this. Next is partner by estoppel. Partner by estoppel. A person is considered a partner by estoppel by estoppel if through his her own initiative her own initiative his own initiative conduct conduct or or behavior he she she gives an impression gives an impression to others gives an impression to others that that gives an impression to others that he she is a is a partner of the firm partner of the firm such partners are held liable for the debts of the firm because debts of the firm because because in the eyes of the third party 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 they they are considered considered partners they are considered partners even though they do not even though they do not contribute they do not contribute capital or take part or take part in its management or take parts in its management. Just take an example. Suppose Rani is a friend. Suppose Rani is a friend of Seema, who is a who is a partner in a partner in a software firm, Simplex Simplex Solutions. Simplex Solutions. On on Seema's request, on Seema's request, Rani accompanies Rani accompanies her Rani accompanies her to a business accompanies her to a business meeting to a business meeting with with Mohan with Mohan Softwares and and actively participates actively participates actively participates in the negotiation process in the negotiation process for a business deal for a business deal and gives the impression gives the impression that she gives the impression that she is also a partner. She is also the partner in Simplex Solutions, but in reality she is not. If credit is extended, credit is extended, credit is extended to Simplex Solutions on the basis of on the basis of these negotiations on the basis of these negotiations Rani would Rani would Rani would also be Rani would also be liable for repayment would also be liable for repayment of such debt would also be liable for repayment of such debt as if she is a partner she is a partner of the firm she is a partner of the firm. I believe you understood. I believe you understood this. Next, partner by holding out. Partner by holding out. A partner by holding out. A partner by holding out is a person. A partner by holding out is a person who who though is not a partner, though is not a partner in a firm, but knowingly, knowingly, knowingly allows himself to be represented, to be to be represented as a partner, to be represented as a partner in a firm, represented as a partner in a firm. Such a person, such a person becomes liable, such a person becomes liable to, liable to outside creditors for repayment of, for repayment of any debts, for repayment of any debts which have, which have, which have been extended, which have been extended to the firm, which have been extended to the firm on the basis of, on the basis of, on the basis of such representation, on the basis of such representation, on the basis of such representation, in case, in case he is not really a partner, in case he is not really a partner and and wants to save himself, wants to save himself from such a liability, from such a liability, from such a liability, he should, he should immediately, he should immediately issue a denial, issue a denial, clarifying, clarifying his position, clarifying his position that, that he is not a partner, clarifying his position, he is not a partner in the firm, not a partner in the firm. If he does not do so, if he does not do so, he will, he will be responsible, he will be responsible to the third party, he will be responsible to the third party for any such debts, for any such debts. Kindly refer it once more. Partners by holding out. A person by holding out is a person who, though is not a partner in a firm, but knowingly allows himself to be represented as a partner of the firm. He allows other to tell him that he is also a partner and he is knowing that. So such a person becomes liable to outside liabilities, outside creditor for the repayment of any debts which have been extended to the firm on the basis of such representation. In case he is not really a partner and wants to save himself from such liability, he should immediately issue a denial and clarify his position that he is not a partner in the firm. If he does not do so, he will be responsible for the third party for such debts. He will be responsible to the third party for such debts. I believe you understood. So this was partnership by holding out. Let's see partnership by estoppel. A person is considered as a partner by estoppel he if though his own initiative, conduct or behavior gives an impression to the others that he is a partner in that firm, and such partner is held liable for the debts of the firm, because in the eyes of the third party they are considered as partner even though they do not contribute capital or take part in the management. The example of Rani and Seema is listed. So, suppose Rani is a friend of Seema who is a partner in a software firm, Simplex Solutions. On Seema's request, Rani accomplishes her to a business meeting with Mohan Softwares and actively participates in the negotiation process for the business deal and gives the impression that she is also a partner in Simplex Solutions. If credit is extended to Simplex Solution because of this, Rani would also be liable for the repayment of such debt, and she is also a partner of the firm. Let's see what we have learnt in today's class. Let us quickly see what we have learnt in today's class. Let us see partnership by holding out, partnership by estoppel, holding out we have seen. So a person is considered by a partner by estoppel if through his or her own initiative, conduct or behavior, he gives an impression that he is also a partner in a firm, and such partners are held liable for the debts of the firm, because in the eyes of the third party they are considered as partners even though they do not contribute any capital, or they do not participate in the management, or they do not share any profits. The example of Rani as Seema is given over here. Suppose Rani is a friend of Seema who is partner in a software firm, Simplex Solutions. On Seema's request, Rani accompanies her to a business meeting with Mohan Software and actively participates in the negotiation process for a business deal and gives the impression that she is also a partner in Simplex Solution. If credit is extended to Simplex Solutions on the basis of these negotiations, Rani would also be liable for the repayment of such debt as if she is a partner of the firm. I believe it is clear. Let us see what we have learnt in this chapter. Let us see what we have learned in this lecture. So we began with forms of business organization. We began with forms of business organizations. We understood that business ownership is a bundle of rights. Business may be owned singly or business may be owned jointly. Business may be organized as a proprietary or a corporate concern. Then we shifted to sole proprietorship, that is single owner. We learnt in detail the meaning of sole tradership, sole proprietorship. We have seen the features, merits and limitations of sole proprietorship. The introduction of capital could be in cash or kind, both is possible. Features we have learnt. Then we shifted to Hindu undivided family business, HUF, in which we have learnt the three generations, grandfather, father and children, constitute a HUF, Hindu undivided family, and Hindu Succession Act is applicable to HUF. We learned the features of HUF, the merits of HUF and limitations of HUF. HUF, this act is already, basically Hindu Succession Act is also applicable on Parsis, Buddhists, Jains and Sikhs, and obviously Hindus. We shifted to partnership then. We have learnt about the meaning of partnership, the features of partnership, the merits and limitations of partnership in detail. And then we shifted to types of partners. Types of partners, active partners, dormant partners, which are also known as sleeping partners. So, dormant partners are the ones generally they share profits and losses, but they do not participate in the management of the company. whether active partners take participation in the management of the company. Secret partner, in the eyes of the general public, he is not a partner, but actually he is a partner secretly. Nominal partner. Then we have learned partnership by estoppel, and at last we have learned partners by holding out. Partners by holding out. I believe you understood till here. We are stopping here. We are stopping here. We'll continue from here in the next class. Thank you. Thank you.